The main difference between JEPQ and QYLD lies in their investment strategies. QYLD uses a covered call strategy to generate high monthly income by selling call options against the stocks it holds, which limits potential upside but provides consistent income even if the stock price remains stagnant or falls slightly. In contrast, JEPQ employs a combination of covered calls and actively managed stock selection to generate income and potentially some capital appreciation, aiming to capture a portion of the Nasdaq's returns with lower volatility. As a result, QYLD is more attractive to investors seeking high monthly income with limited capital appreciation potential. In terms of expense ratios, JEPQ has a lower ratio of 0.35% compared to QYLD's 0.60%, making JEPQ a more cost-effective investment. This lower expense ratio translates to reduced fees for investors, potentially leading to higher net returns over the long term. Therefore, JEPQ is more preferable for investors seeking to optimize their investment performance by minimizing expenses. QYLD offers a significantly higher dividend yield compared to JEPQ, primarily due to selling call options against the stock's yield within the fund, generating regular income for shareholders. However, this high yield comes at the expense of potential capital appreciation, meaning QYLD's primary goal is to generate income rather than grow the principal amount invested. In contrast, JEPQ aims to balance income generation with potential capital appreciation, resulting in a lower yield but possibly higher long-term returns. Despite their differences, JEPQ and QYLD share similarities, such as utilizing a covered call strategy to enhance income for investors and aiming to expose investors to specific market segments. Ultimately, when comparing JEPQ and QYLD, the choice between the two depends on individual investment goals. While QYLD has a history of consistent monthly dividend distribution,